Introduction to Leveraged Buyouts, LBOs. Understanding acquisition strategy with debt financing. Presentation overview, structure of LBOs. This section will cover the definition, characteristics, and key players involved in LBOs. Analysis and valuation techniques. This section will explore the analysis and valuation techniques used in LBOs, including leveraged buyout analysis, discounted cash flow analysis, and comparable company analysis. Pros and cons of LBOs. The section will examine the pros and cons of LBOs, including the potential benefits and risks associated with this type of transaction. Understanding LBO structure. What are LBOs? LBOs or leveraged buyouts are a type of acquisition in which a significant portion of the purchase price is funded with debt, often in excess of the assets of the acquired company. Characteristics of LBOs. LBOs typically involve a high degree of financial leverage, with debt often exceeding the assets of the acquired company. They also often involve a change in ownership and a restructuring of the company's operations. Types of LBOs. There are several types of LBOs, including management buyouts, management buy-ins, and secondary buyouts. These types differ in the identity of the buyer and the source of funding. Key players in LBOs. The key players in LBOs include the sponsor, who raises the funds to finance the acquisition, the lender, who provides the debt financing, and the management team, who may participate in the acquisition and are responsible for running the company post-acquisition. Definition and characteristics of LBOs. Definition of LBO. LBOs are a type of acquisition in which the majority of the purchase is financed through borrowing, using the acquired company's assets as collateral and paid off through its cash flows. Characteristics of LBOs. LBOs typically involve the acquisition of a public company by a private equity firm, using significant amounts of debt and high degree of financial leverage. Types of LBOs. Management buyouts, MBOs. In management buyouts, the management team of the acquired company acquires the company from its current owners. These transactions are typically financed by a combination of debt and equity. Management buy-ins, MBIs. Management buy-ins involve an external management team acquiring a company, typically with the backing of a private equity firm or other investors. Secondary buyouts. Secondary buyouts involve a private equity firm acquiring a company from another private equity firm. These transactions are often driven by the desire of the existing firm to exit its investment and realize a return, while the acquiring firm sees an opportunity to create value through operational improvements or other strategic initiatives. Key players in LBOs. The sponsor. The sponsor is usually a private equity firm that provides the equity financing for the acquisition in an LBO. The lender. The lender often includes a syndicate of banks that provide the debt financing in an LBO. The management team. The management team is responsible for running the acquired company in an LBO. LBO analysis and valuation. LBO analysis. LBO analysis involves examining the various factors that can impact the success of an LBO, including company financials, market trends, and competition. This analysis enables investors to assess the risk and potential return of an LBO investment. Valuation techniques. There are different methods used to value a company in LBOs, including discounted cash flow, comparable company analysis, and precedent transactions. These methods help investors to determine the fair market value of the target company. LBO analysis, cash flow analysis. LBO analysis involves analyzing the cash flows of the target company to determine how much debt can be used to finance the acquisition. Equity returns and risks. LBO analysis also considers the expected returns to the equity investors and the potential risks associated with the acquisition. Optimal financing. The goal of LBO analysis is to determine the optimal amount of debt and equity financing to use in the acquisition. LBO valuation techniques. Discounted cash flow, DCF. The DCF method involves projecting the future cash flows of the target company and discounting them to the present value using a weighted average cost of capital, WACC. This method is useful for companies with stable and predictable cash flows. Comparable company analysis. The comparable company analysis method involves comparing the target company to similar publicly traded companies using valuation multiples such as price to earnings ratio or enterprise value to EBITDA. This method is useful when there are comparable companies available for analysis. Precedent transaction analysis. The precedent transaction analysis method involves comparing the target company to similar companies that have been acquired in the past using valuation multiples such as price to earnings ratio or enterprise value to EBITDA. This method is useful when there are similar acquisitions available for analysis. Advantages and disadvantages of LBOs. Increased operational efficiency. LBOs can increase operational efficiency by reducing costs, streamlining operations, and improving management incentives. This can lead to improved profitability and increased shareholder value. Potential for significant returns. LBOs can generate significant returns for investors by allowing them to purchase a company at a discount, improve its operations, and then sell it for a profit. This can provide investors with an attractive return on their investment. High degree of financial leverage. LBOs involve a high degree of financial leverage, which means that the acquired company can have a significant amount of debt. This can increase the risk of default and financial distress, especially during an economic downturn. Potential for conflicts of interest. LBOs can create conflicts of interest between the private equity sponsor and the management team of the acquired company. This is because the private equity sponsor may prioritize its own interests over those of the acquired company. Advantages of LBOs. Financial returns. LBOs can generate significant financial returns for investors due to the increased leverage used to finance the acquisitions. Operational efficiency. LBOs often result in increased operational efficiency and cost savings due to the focus on improving productivity and reducing waste. Long-term strategic view. LBOs enable investors to take a long-term strategic view of the acquired company, as opposed to short-term financial gains that may be the focus of public companies. Disadvantages of LBOs. High financial leverage. LBOs involve a high degree of financial leverage, which increases the risk of financial distress if the target company's cash flows are insufficient to service the debt. Conflicts of interest. There is a potential for conflicts of interest between the private equity sponsor and the management team of the acquired company, which can lead to disagreements and negatively impact the operations of the company. Conclusion. LBOs are a complex and often controversial acquisition strategy with a potential for significant returns, but they come with a high degree of financial risk and potential conflicts of interest. Understanding the structure, analysis, and valuation techniques used in LBOs is essential for anyone considering this type of investment strategy. Thank you.